Good to see. Good to see everyone here. You can see from the title of my presentation, Metals and Miners, Still a Generational Opportunity. The title of my presentation a month ago in Vancouver at this show was, It is a Generational Opportunity. In the 30 days or so since that show, it's amazing, gold gained $200 an ounce. And then over the last week or so, it's lost about half of that. So it's been an interesting ride. It has forced me to update my presentation a couple of times since then. But let's go into what's happening or what I think is happening. Gold started the year in gangbuster fashion. This is the 1-month chart of gold, and you can see that $200 rise since really since the Vancouver shows, the Vancouver MIF. And then we've lost that $100 since then. This is a 3-month chart. If you pull back a little bit, that decline doesn't look quite as bad, but it still looks pretty serious. If you go back to, well, before we go back to a year chart, this is the chart that I put up last year at this very conference, which basically marked the start of this bull run, this new gold bull market. That was a chart I had. I showed the challenge from last year was that we had hit about 2,000 and not quite 2,100, 1, 2, 3, 4 times, and we had yet to break through. Now, at that show, at this podium, I said, I think we're going to break through pretty soon. What I didn't know is while I was speaking, that was happening. While I was speaking, gold was starting to rise that day, and by the afternoon it was up $40, and it did not stop for about the next month or so. So I had to rush up to my room, get an alert out to my readers, and say the game is on, and all of that good stuff. And it was. We broke through that, and here's our 1-year chart. Now that decline over the past week, 10 days, doesn't look nearly so bad in that context. In actuality, it's very much in line with the kinds of declines that we've already seen in this bull market. We've come a long way, baby, and this decline is, I think, a bona fide correction. I think it's fairly serious, but I think we're going to put it behind us. The latest challenge for gold was that narrowing triangle, that flag pattern that you see marked. At the Vancouver show, I marked that on the chart, and as I was getting ready to go up the next day, I had to update that chart because gold broke through that channel and on that really furious run that we saw over the last week. What I really want to point out here, though, is that 200-day moving average. That's right about $2,600 right now, a little bit below that. That's the support, and that, if you look at this being a significant correction, in fact, we have a couple of times tested the 200-day moving average in this bull market, this 1-year-old bull market. Never has that 200-day moving average been so far below the current price, though. So that's kind of the support. That's what we could test very likely and still have this bull market very much intact. But I don't think we're going to get that far. But still, all said and done, this has been a furious rally over the last month, and we were due for a correction. We have to take some of that froth off the market, and that's happening right now. So let's look at the long-term driver. If you've seen any of my presentations over the past month, year, 4 or 5 years, really, this is the thing that I've been talking about. We're in the end game of a 45-year-long trend of ever easier money. And I won't get into all of the details on that, but this is the big thing. This is the U.S. national debt. Familiar chart, a lot of people use this. The debtclock.org, $36.5 trillion. This is about a week old, 4 or 5 days old, so that's a much bigger number. The important thing to note is at the bottom, those circled numbers. In 1980, when Paul Volcker started lowering rates, and he started this 45-year trend of ever easier money, he could raise rates to over 20% to kill off inflation because the debt to GDP ratio was only about 34, 35%. So he had the tools to do that. Now, Powell can't do that because of that other circled number. And right now it's 123. It's been as high as 135% debt to GDP recently. The bottom line is Powell just does not have the same tools in the toolbox. What happens when you have debt as large as it is now is that even a small increase in interest rates is extremely leveraged to that large number. So if you increase rates as much as the Fed did during this last hiking cycle, which arguably was the harshest hiking cycle in history, then you get numbers like we're getting now, $1.1 trillion in interest payments just to service the debt, more than national defense. That number, to put it in perspective, is $167 billion at $36.5 trillion debt. $167 billion just since last month's MIF, and that number is a few days old. That's a run rate of $2 trillion a year in the deficit. It's also 2.08 trillion more than last year's MIF. So good luck to Doge. They are running right now at about we can actually see it on here. They're running this on that debt clock, the Doge clock, $133 billion. That's not 1/15th of the deficit that we had over the last year and the run rate that we have right now. So that brings up the brick wall that's blocking the Fed from not only raising rates any longer, but leaving rates at this level. This is why Powell is so desperate to cut rates, because right now he's paying $1.2 trillion a year just in interest payments, and that number is rising. Another reason is this. A lot of that debt was rolled over when we had zeroed interest rates. Yellen was floating the U.S. debt with bills, short-term Treasury paper. That paper is rolling over right now. $10 trillion this year has to be rolled over at current interest rates. That's going to massively increase the amount of interest payments we're going to have. So that number that I just had is going to rise precipitously. In addition to this, you have corporate debt that has similar issues of debt rolling over this year. This is a year where I think it all happens. This is where all of the chickens are going to come home to roost, and this is why the Fed has been so desperate to cut rates. Now, let's look at the short-term driver. Cracks are spreading in the global gold market. We've seen that happen over the last month. That has a lot to do with that furious $200 rise that we saw in the gold price. The physical gold market is really stressing right now. Some people say it has to do with tariffs, but I think it's a lot more. Massive amounts of gold and silver flowing from London to New York. And again, everyone thinks this is due to tariff threats, but the evidence really is pointing to a lot more. Extraordinary gold flows. These are the gold stocks on the COMEX. You can see they've soared to basically pandemic levels. A tremendous amount of gold has flown from London to New York in that time frame over the past couple of months. Swiss gold exports have absolutely soared. This is kind of a byproduct because what's happening is these 400-ounce good delivery bars, the central bank gold, has to be melted and recast into 100-kilogram and 1-kilogram bars to go to the COMEX. That happens in Switzerland. So this is a sign of those tremendous gold flows. Gold deliveries. Now, this is a thing that argues against tariffs. I can understand gold going from London to New York because of the fear of tariffs. But there's been a surge in deliveries on the COMEX. These are the people who are taking those futures contracts and actually standing for delivery. In other words, they're not rolling over the contracts, they're not settling for cash, they are taking the gold. The key point here that a lot of people miss is of that huge amount of gold deliveries, a good portion of that is simply a receipt. In other words, the gold is still staying on COMEX. How much is actually coming off of COMEX and being physically taken away from COMEX, we really don't have a good handle on yet. But still, these are extraordinary gold flows. This is not ordinary. And now, an audit of Fort Knox. Here we see in an interview Secretary Besant claiming that all of the gold is in Fort Knox and it's audited annually, and any senator, if they want, can go look at it. As I said in this tweet, this post on X, well, that's news to simply everybody. There has been no decent audit of gold in Fort Knox for decades. The supposed look-see into the vaults in 1974 was a farce. Really, they didn't count the gold or anything else. So the gold needs to be counted. It needs to not only be counted, it needs to check on all the encumbrances on it, who actually owns the gold. So this is really interesting, and it's part of the bigger picture. What we have is a bull, or really a few bulls, in the establishment China shop, rampaging through and breaking things. We have a lot of paper being shredded. We have a lot of evidence being burned and destroyed. We have, frankly, an establishment that is scared witless, and I think that has a lot to do with these unusual gold flows that we've been seeing. Some possible explanations for this: the huge central bank gold sales of the 1990s. This is something we had a hand in exposing back in the 90s when we published something called the Gold Book, written by Frank Veneroso, a brilliant market economist who did volumes of research, tremendous research, and published this seminal work, the Gold Book, that explained and revealed how thousands of tons of central bank gold was being loaned to bullion banks, who then immediately sold that gold, took the proceeds, put it in treasuries, and used that as leverage for more speculative investments. We don't know if that gold has ever been paid back. Now, that gold may have been paid back in cash, but never replaced as bullion. So there's a very good chance that what many citizens think that they have in their government central bank gold reserves just isn't there. And there's a chance that that actually extends to Fort Knox as well. That could be behind these massive physical gold flows. It could be, and this is not exclusive, it could also be that the massive paper gold and paper silver fractional banking schemes out there, where every claim on a gold, every ounce of gold in COMEX may have as much as 100, 150, or 200 claims for each ounce of gold, that this is actually being in danger of toppling. Or this could just be a glitch in the market, like what happened after COVID, and already be in the process of normalizing. All of these could be true to some extent. That last point is something that the World Gold Council is very eagerly putting out there right now, that everything's normal, everything's fine. But that's kind of their par for the course for the World Gold Council. We'll see. But some things are unwinding right now, not just gold, but tech stocks and a lot of speculative investments, crypto. So there's a great reckoning going on in the market right now. Gold right now is suffering from that, but gold, I think, will be the ultimate winner no matter what happens. There are some warning signs here. Gold's RSI, I came up with these charts on Monday, warning of a correction in gold. Well, it's already happened, so it's kind of a fait accompli here. But if you look at the RSI for gold in the previous two instances, kind of early on in this gold bull market, where we got overbought, things got a bit frothy, we had a bit of a correction. In actually three previous instances. That happened, and we're in the middle of that correction right now. More concerning to me is this chart by my friend Ron Grease at thechartstore.com. This is, as you can see, he's marked two other occasions, and this goes back pre-COVID as well. Two other occasions where price spikes above the 100 line on the percentage of the Bollinger Band. In other words, the upper Bollinger, the price spiked through that and stayed there for some period of time. Those circled instances were followed by corrections that ranged 6 to 9 months or so, and were pretty deep corrections. This is the third instance where that has happened. So that's a bit concerning to me, but I do take some comfort in the fact that this is a lot different than the markets we had pre-COVID and after COVID. Something different is going on right now, and the last year, I think, is evidence of that. There is a positive sign in silver. We have a inverse head and shoulders pattern that projects to about a $40 price in silver. And I can tell you that over the past few days, I've had discussions with some friends of mine in the physical metals industry, and there are tremendous silver shortages right now. There's a real supply crunch going on in silver right now. And it's not just monetarily. It isn't the kind of silver crunch where we've seen before, where it's been Western investors buying it for investment demand. That's kind of absent completely. But the physical demand for silver for industrial usages is really putting a pinch on the market right now. So silver looks like it could outperform gold, as it should have been for a long time. And that's in the near future, in my opinion. The bottom line here is that we have a long-term, monetarily based gold bull market in progress. And this is a generational opportunity like we haven't seen since the early 2000s. Now, that was a special time. I can see from this audience that many of you were around in that market in the 2000s, and you knew what happened. You knew that the metals prices were rising strongly, but also the junior mining stocks, and that's the important part. You were able to get leverage, and that rising tide lifted all ships. So even your losers didn't lose much, if anything at all, but the winners were going up 3, 4, 5 times, 10 baggers and even 20 baggers and more. So that was the kind of environment where it was very easy to build wealth very quickly. We've had a tremendous reaction in the metals. We're actually at a better place now than we are in the early 2000s, because right now gold is at historic highs. Back then it took a lot of courage to believe that gold was going to set new price records. We're there right now, so all we're missing are the mining stocks. And with the kinds of earnings that the big majors are getting, I think it's only a matter of time before this filters down to the juniors, especially when you consider the fact that all of these other speculative markets are in trouble right now. The tech stocks, the AI thing, and Bitcoin are all in trouble right now, and I think you're going to see some speculative money looking for other opportunities like we provide in this sector. So what kind of potential are we looking at? I marked 3 historic bull markets in gold before the one we're currently in. The early 70s, where gold went up 5.6 times. The later 70s, when it went up 8.2 times from trough to peak. The 2000s, it went up 7.5 times from trough to peak. And if you mark the bottom in this market at about $1,050 thereabouts, and you figure that we're going up 6 to 8 times from there, but when all of this eventually gets resolved, then you're looking at a $6,000, $7,000, $8,000 gold price. I will caution, though, that it's not going to be, although the last couple of months and the last year have been quite extraordinary, it's not going to be a straight line. We've come a long way, and we will have some setbacks along the way. But at some point, if this is the kind of major secular bull market like we've seen 3 times before, that's where it's going to end up. And of course, timing is always the tricky part. So gold stocks, there's still a generational opportunity. This is the GDX divided by gold, the ratio of the GDX senior mining stocks index divided by gold. And you can see that from the end of last year through the first week or so of February, the gold stocks were leveraging gold very strongly. That was very encouraging. And now, of course, we have that correction. It's leveraging gold again, but to the downside. That's the opposite side of the coin. So we're paying for that leverage, but we are seeing leverage with the mining stocks, and that's important. So it's still a generational opportunity. That's all I have to say for you today. We will have a Q&A session in the Parkdale room following this. So if you have any questions on what I've talked about here, please come. But this is, I'll end it with this. This is a truly the kind of opportunity, or even better than we had in the early 2000s. The companies out there will provide the kind of leverage to the metals. It's only a matter of time. and you really need to find the better stories out there. And there are a bunch of them. There's a lot of value. It's a target-rich environment. I have 5 of the best companies that I see out there that are in our portfolio in Gold Newsletter presenting today. And they run the gamut. There's a little bit different with each story, and they're all very exciting, so why don't we just get into it right now? And again, we'll have a Q&A session afterwards so you can ask some detailed questions of all our presenters.